Topic: Other asset allocation approaches. Examines alternative portfolio construction methods beyond traditional mean variance optimization. The topic emphasizes that investors increasingly use more flexible and risk-focused allocation frameworks to address the limitations of conventional portfolio theory. These approaches seek to improve diversification, manage systematic risks, and align portfolio construction with evolving market conditions and investment objectives. The topic introduces several important allocation methodologies, including the core satellite approach, top-down and bottom-up analysis, risk budgeting, factor-based allocation, risk parity, and other quantitative portfolio strategies. It also explores the new investment model, which separates sources of beta and alpha. Together, these approaches provide investors with broader tools for constructing diversified and adaptable investment portfolios. One major framework discussed is the core satellite approach, which combines passive and active portfolio management within a single investment structure. The core portion of the portfolio typically consists of diversified passive investments designed to capture broad market exposure efficiently and at relatively low cost. The satellite portion contains actively managed strategies intended to generate excess returns, or alpha, through security selection, tactical positioning, or alternative investments. This structure allows investors to balance stability and diversification with targeted active risk-taking. The topic emphasizes that the distinction between core and satellite assets depends on investor objectives and risk tolerance. For one investor, venture capital may represent a satellite allocation, while another investor may treat it as a strategic core holding. The topic also compares bottom-up and top-down asset allocation approaches. Bottom-up investing focuses on individual securities, funds, or managers by analyzing company fundamentals, operational quality, and security-specific opportunities. In contrast, top-down investing emphasizes macroeconomic conditions, monetary policy, interest rates, geopolitical trends, and sector allocation decisions. A mixed approach combines elements of both frameworks. The topic explains that each method offers advantages depending on market conditions and investment goals. Top-down approaches may perform well when macroeconomic trends dominate market behavior, while bottom-up analysis may identify undervalued securities or niche opportunities. Effective portfolio construction often requires integrating both perspectives to balance broad economic insights with detailed investment analysis and security selection. Risk budgeting and factor-based implementations represent another central theme of the topic. Risk budgeting allocates portfolio risk rather than capital across investments, ensuring that no single asset or factor dominates total portfolio volatility. Investors define risk buckets and determine how much risk each component should contribute to the overall portfolio. Factor-based risk allocation further decomposes portfolio risk into exposures such as value, momentum, interest rates, inflation, or economic growth. This approach improves transparency regarding the true drivers of portfolio performance. However, the topic notes that factor-based strategies require regular rebalancing and may be difficult to implement when short-selling constraints exist. Risk attribution analysis is therefore essential for understanding portfolio exposures and maintaining diversification across systematic risk factors. The topic also examines risk parity and other quantitative portfolio allocation strategies. Risk parity seeks to equalize the contribution of each asset class to total portfolio risk rather than allocating based solely on capital weights. Because lower volatility assets contribute less risk, risk parity portfolios often use leverage to increase exposure to traditionally safer assets such as bonds. The topic explains that risk parity is motivated partly by the volatility anomaly, where lower risk assets may generate unexpectedly attractive risk-adjusted returns. Other quantitative approaches discussed include equally weighted portfolios, inverse volatility weighting, minimum volatility strategies, and market capitalization weighting. Each method reflects different assumptions regarding diversification, risk compensation, and market efficiency, offering investors multiple frameworks for systematic portfolio construction. Finally, the topic introduces the new investment model, which separates the pursuit of beta, alpha, and portable alpha into distinct portfolio components. Beta exposure represents systematic market risk captured through strategic asset allocation and passive investments. Alpha generation involves active management strategies, seeking excess returns from market inefficiencies, often through alternative investments such as hedge funds or private equity. Portable alpha refers to generating alpha independently from the source of beta exposure, allowing investors to separate active skill from market exposure. The topic concludes that modern asset allocation increasingly emphasizes flexibility, factor diversification, and risk management rather than relying solely on traditional market capitalization approaches. Successful portfolio construction, therefore, requires integrating quantitative analysis, strategic judgment, and adaptive investment frameworks to meet evolving investor objectives and market conditions.